Welcome to another Leumi Financial Corner. With us once again, Michael Zaremsky, head of U.S. Private Banking, Bank Leumi USA. Michael, good to speak with you. How was your Passover holiday?
Passover was wonderful, Zev. Thank you very much. Hopefully yours was as well.
Yeah, thank you. Thank you. It was, and it's over, and we live in very, very challenging times, to say the least, but we hope everybody's healthy. That's the most important thing.
Absolutely. And before we get going on our discussion, as always, I'd like to just thank everybody who's worked so hard to keep us all safe and healthy, particularly all the healthcare workers and all the first responders who have put themselves at risk to help others. So just like to say thanks to all those people.
Now, you're the expert, and you look at the markets. One day it's good, and the next day it's down, it's up and down. From your professional perspective, what's going on?
Zev, that's an excellent question, and I think a real key part of that answer is that volatility is really tied to certainty or frankly, uncertainty in this case. Markets are forward discounting mechanisms, and the markets are basically looking out into the future and trying to make an assessment on the future value of cash flows and revenues. So when you start to see volatility pick up in the marketplace, it means that there's some element of uncertainty. So if you think about it in a world of stability, things like bonds where you have a fixed income coming in from a coupon, and you have a very stable interest rate, you would expect to have very little movement in a bond price. But when you look at something like an equity security where you're really not getting paid a dividend or a yield or a coupon, but you're really looking out over the growth rates, when you start to get uncertain times, you start to get a lot of fluctuation and variability in the model as to what the projection is for those cash flows, future cash flows or revenues. So you start to get a whole lot of uncertainty. And I think the challenging thing that we're seeing right now is market information is changing very rapidly. Information, expectations, and what the path forward is changing very rapidly. And one of my children asked me a question about the markets because we have it on the TV all the time. And I explained to them kind of the concept of a bell curve. And I said, when we first started getting all the information about the coronavirus, we started to lay out all the different elements of what's the probability of, good news, bad news, worst case, best case, all these different elements of it, how long it could last, how short it could last, and what the average would be. And when the crisis starts happening and when the information starts to get digested, it tends to have a fat part of the curve at the back end because there's a lot of uncertainty at the back end and you have to assign some probability to it. As elements clear up, you start to eliminate elements of the back end and you start to kind of get a better normal curve with more normal volatility. The other way that we explained it is, and maybe easier for many of us on the Northeast to picture, when you think about hurricane season coming, at some point in time when we start to see hurricanes form down in the Gulf or off the coast of Florida, they have this hurricane cone. And they tell you what the predicted pattern is going to be for day 1, 2, 3, 5, 7, etc. And the cone is really, really wide when you get out to 5 and 7 days. But the sooner days, 1 day, 2 day out, are a little bit more certain. And as time goes by, the cone narrows and narrows and narrows until you get a better understanding of where it might possibly hit. And I think that that's kind of what we're looking at in terms of the nature of today's volatility in the marketplace.
Now, is the fact that the president and even the governor of New York are talking about opening up and going back, at least slowly going back to a more normal status, does that have any impact on the markets too?
Absolutely. And what I think is interesting is many times people have a very linear view of what's going to happen. And people will say, well, this is where we are right now. Let me just extrapolate today's events all the way out without any action or reaction from any outside forces. So when the whole crisis really started to hit, people started expecting the worst. But if you think about all the different changes that have happened in the last month or so, again, massive fiscal stimulus from the government came in and backfilled about $2 trillion worth of aid for the public, including the SBA program, which is commonly known as PPP, to help the Payroll Protection Act for small businesses. The Fed stepped in and dropped interest rates really, really rapidly by 150 basis points and came up with a quantitative easing program that was originally at $700 billion and then increased from there. We've also seen massive responses from the corporate side. And I continue to be amazed at the production shift for, auto companies to start making ventilators, for apparel companies to start making masks. So a lot of the worst case scenarios that get built in terms of a linear expectation about how bad things are, there's a reaction all along the way that changes the course of the dynamic of what that line might be. And now when you look at some of the news in today's market coming from the healthcare side of it, you look at the vaccine programs, you look at the testing programs. I'm always amazed at the creativity of, looking at drive-through vaccine testing. And just looking at the news today, there was some really good news that came out from one of the healthcare companies for a drug called remdesivir, where they think it might be progressing much further than anticipated in terms of vaccine. So when you think about the fact that right now there's 70 vaccines under development, there's over 200 different programs out there, and you think about how the government has reacted in terms of deregulation to make it easier for companies to move ahead quickly with testing, massive change in terms of what the original expectations were. And then specifically to your point, with some of the announcements made in the last couple of days in terms of how we open up the states, again, very important to understand that in our country, we have 50 individual states which have 50 different governors, and all of those 50 states are being afflicted by the virus in different ways. Where we are in the Northeast, particularly New York, New Jersey, and in our markets, things are particularly bad, but there's a lot of other parts of the country where it's frankly just not nearly as bad. So this rolling opening of the economy, again, I think eliminates a lot of the back tail end of worst case scenarios and starts to put us in a position where, again, we may be in a much better position than we thought. Speaking to people that I'm friends with and some coworkers, some of my coworkers come from upstate New York. One of my coworkers, her mom is a nurse in one of the upstate New York counties. They have one or two people in the county that are afflicted. It doesn't necessarily make sense for that county to behave in the same way that we're behaving in New York. So as we continue to move ahead with some of the protocols, again, there's gradual reopening of the economy. There's gradual reopening of different states. It's not going to mean that we're going to necessarily snap back to normal quickly, but it takes a lot of the worst case scenarios off the table.
And that helps the market become more stable.
Absolutely, because again, as a fiduciary for capital, market exposures, we have to take into account worst case scenarios. And I think one of the challenges that many of us also run into is, how much confidence do you need to have in the prognostications for the future before you start dipping your toe in and make investments? If you want to wait until the whole world is vaccinated or until everybody in the United States has a test, the market's going to move in advance of that because, again, the market is a forward discounting mechanism. So what you're seeing today is people starting to, I hate to use the term, but starting to bet that, again, more and more of the worst case scenarios are starting to come off the table a little bit, and the optimism of a better outcome than worst case scenarios continues to play itself out. Again, that could change over the weekend. That could change by Monday. And if something bad happens with some of the tests that are happening or the vaccines don't look like they're moving ahead as quickly as possible, or, again, something happens on the other side where some states say, hey, you know what, we're not going to be ready until June 1st, again, you'll see some more volatility going the other way, and that will be because some of the worst-case scenarios are starting to creep back into the picture. But because the worst-case scenario and the best-case scenarios have such a big divergence between them, you're seeing a huge vacillation between good news and bad news and how that impacts the market because we're making assessments, 4 to 6 months out. Again, it goes back to the whole concept of the hurricane cone. We're betting today on the market for results that are going to be happening 4 to 6 months out. So any little wobble in that hurricane cone would dramatically change where the hurricane may end up. So again, any changes in the near term can dramatically affect what the future outcomes are. So that's why we're seeing the volatility. But what I would like to add, a lot of people have come to me and said, well, should we have just closed the markets for a while? And what I continue to tell people is the volatility is not bad. The volatility, again, means that the market is clearing. So for people that are very concerned, they may be selling off. For people that are more optimistic, they may be buying. But the market gives us a mechanism to really make that assessment. And I'm very encouraged by the fact that we've kept the markets open, that the markets continue to stay open, and the markets continue to be one of the arenas where we can continue to assess the risk going forward and, frankly, the opportunities going forward.
Michael Zaremsky, thank you for giving us some insight into the volatility of the market, what it all means. Michael is head of U.S. Private Banking, Bank Leumi, USA. Thank you.
Thank you, Zev. And I'd just like to remind everybody these are my views, not necessarily the views of everybody in the bank. And I'd like to wish you a very happy weekend.
Thank you. And we're going to be right back. Don't go away.